Alright guys, it's Chud Finance, and in today's video, we are going to be explaining a simple way to have a sort of x-ray into investments you're looking to make and catch an idea if they're actually worth doing or not, questions you should be asking. It's basically a simplification of what wealth managers like Goldman Sachs, Morgan Stanley, and the things they already evaluate, like risk, tax structure, income, appreciation, liquidity. This strat works by following a 4-part simple framework any Chud could follow. Each category has a score out of 25. The final score is out of 100. I'll explain how liquidity is a metric we also need to include. Alright, now let me get into this. So the first part is capital preservation. You need to immediately ask, is this thing going to zero? For example, if it was something like cash in the bank, that's really unlikely to go to zero. You know, you put $1,000 in today, next year you go to pull it out, $1,000 is going to be there, highly likely. Some random shitcoin that your Chud-ass friend recommended, look, I think we both know it has a pretty high chance of going to zero. So you just need a general outlook of how your capital will be treated in the investment. Is it risky? Is it not? Now, the next part is tax efficiency. For some of us Chuds, this part might not actually matter due to the amount of income we make or just the effort it requires not being worth it. This does also differ per country. However, I'll explain it anyway real quick. But essentially, you're just asking, what are the tax benefits that are occurring, if any? For example, putting money into your 401k has tax benefits. You may be doing something else with oil and gas and getting some there. Or you may be doing something with no tax benefits. So you're just going to think, is this a tax aggressive strategy, a hybrid, or, none? Next is the cash flow, also known as the yield. The yield is the amount you get from the investment over time without actually losing it. So this can be dividends that you are getting from a stock or passive income from a rental property you are getting. These both can have relatively decent yields. There's also something like a government bond, which may have a low yield, or you might be invested in something like gold, which doesn't return any yields. So all you're looking at, how much cash are you getting from this investment without selling it? And the last part is growth. How fast does the investment grow, or does it actually grow at all? Now, I'm going to give you guys an example, all right? Assume you and your friends, you made a meme coin. You guys think it's going to 1,000x, going to the moon. That would have a much higher hypothetical growth rate than something like putting your money in the bank and getting a 4% interest rate. Okay, now I'm going to go score some investments to show how it works, because it's actually based off your own perception of how well the investment ranks in each category. I'm just going to start with cash, then I'll move on to multiple investments and also mention how liquidity plays its role in that. All right, now fitting cash in the bank into the framework, capital preservation, instantly ask the question, would this go to zero? Highly unlikely. So 25 out of 25, put the cash down today. You could go there in 6 months and get it out. Next, tax efficiency. Nothing much you can do with cash, so I'll give that a 0. Now look, cash flow, you might get a bit of yield from leaving your money in the bank. Maybe it's in a high interest savings account, but that's probably the most you could do. So I'll give it about a 10. Look, anywhere from 10 to 15 in that range. Now, last is growth. That would be a 0 because your cash isn't going up. So scoring this, it would be 25 plus 0 plus 10 plus 0, which would be 35 out of 100. And look, the more investments you personally look at and evaluate, you'll get an understanding of the baseline score that will come up regularly. Okay, Chuds, quickly I'm going to go over the liquidity factor. Basically, all we need to ask is how fast can I move my money out of this thing? So for this, we would just give it a high, medium, low factor. Example of a high liquidity factor would be cash in the bank. You can instantly get it out. Something like a stock would also be high because you could just sell it off, ignoring any tax implications. And a medium to low thing would be something like real estate. It takes a while. But now I'll get into a few investments at the same time so we can see a big table of them. Okay, so we have UPS stock here. UPS, for capital preservation, it's a 100-year-old business, global logistics network. It's profitable, cash flow positive. I would say an investment grade balance sheet. I would give it a 20 out of 25. It's not bulletproof because like competitors like Amazon delivery coming in, but it's pretty safe. Tax efficiency, I'd say 0. It's just holding a stock. And cash flow / yield. UPS historically pays a solid dividend. Dividends are nice, but not massive. So I would say 15 out of 25. The yield is probably 34% on that range. Now growth. UPS is a big player in logistics. However, they're a mature company, so they're not really explosive in the market. So I'd say probably 15 out of 25. So that's a 50 out of 100. Liquidity, high, because it's a stock, you can sell it off easily. And now we'll do some real estate apartment complexes. So it's real estate. Capital preservation, I would say it's really hard to lose your capital when investing in real estate. Look, worst case scenario, you could hold for a while and hope for the best. However, I'll place it around 20. You could probably even say 25, but I'll just put a 20. Tax efficiency is pretty good depending where you live. Good depreciation and other things you could do. So I would say that's about a 15. Cash flow, you get nice rental income. So that's about a 20. Growth, assuming you're investing in a high growth area or at least getting a nice annual growth rate, I would say it's a 15. So that's a 70 out of 100. But the liquidity liquidity is low, and we'll get how this all plays together with all the investments. All right, lastly, I'll just chuck in Bitcoin. Capital preservation, we'll say that's about a 5. Look, I mean, we'll say 5 to 10. You know, Bitcoin's a pretty risky asset. We all know this. Tax efficiency, we'll put that at a 0. You can't really do much unless you're doing staking or whatever, but not really. Cash flow, you could probably say a 5. Growth, let's assume you're saying Bitcoin's digital gold, put that as a 25. Liquidity is high for Bitcoin. You can sell that off pretty easily. Okay, looking at the final scores, we can see the UPS stock and Bitcoin both have high liquidity, but they are the lowest numbers. Now, why? Because you're paying a liquidity premium when you're putting your money into something like real estate because it's locking your money up. It does have the highest score. However, you can't easily pull that cash out if you need to in emergency or whatever, like the other ones. Look, all this is personal rating, but it helps you get a feel of the investment you're making. It helps us figure out where we stand on the investment and see if it's worth taking and being less emotional during it. Thank you guys so much for watching. Drop a like and subscribe. I hope you like this simple framework that can help you make questions and investments.